So again, so far it's all been about guidance and adjusting guidance and sort of, unraveling this, call it surprise factor. Yes, there is some risk. It's very hard to gauge. I'm not that worried in the next, call it 3-4 months. I think the economy and the market can sustain, the first, call it 100 basis point, increase in Fed fund policy rate. I think the bigger question really becomes, where do we stand and how are they guiding later this year? And what does that mean for 2023 outlook?
So, and what do you expect 2023 outlook? And to the extent that there are investors who are watching us right now, thinking about whether you want to be in this market, when you want to be out of this market, where you want to be in this market, what are you telling them?
So I think you have to be very nimble. I think you have to be quite dynamic. So there's a few areas of the market that we really like where, again, I would say higher conviction views from our side. Energy is the first one I'll mention. That's been our highest conviction overweight sector in 21 and also now in 2022. If you look at our outlooks, we think that there's a valuation argument. We think there's a good fundamental story, improving credit profile, dividend story, and I think there's a pretty attractive, it serves as a pretty attractive hedge against not just inflation, but in this very specific case, geopolitical risks like the one we're facing in Russia, Ukraine. So that's one area we're highlighting and we continue to like. Travel is the other big, call it, theme that we like. So areas like cruise lines, airlines, leisure, we think that trade still has plenty of juice in it. And then I think it's time to start looking at parts of growth, whether you look at high quality growth or even the unprofitable tech segment where sentiment has turned quite negative. I think there's actually quite a lot of good opportunities and time to start stock picking there as well.